Hi everyone, I'm Akshara Menon from famous Bazaar. I would like to welcome you to another session of our Fund Manager interview series. When the market becomes volatile, we often turn our attention towards quant strategies. These quant strategies are known for their adaptability to recognize the patterns and also to respond with the speed and adapt to the changing conditions. The qualities are very especially using these turbulent times. So, with this interview with Mr. Vivek Sharma, Head Investment SC, is a perfect choice. Vivek has over 20 years of experience in trading and investing. He is an IIT Kharagpur graduate and spent over a decade trading international markets with Futures First, where he established their energy trading desk and trained hundreds of successful traders. With over past 8 years of experience, Vivek has focused on trading and investments, currently running a successful small case portfolio. These portfolios are built using multi-factor methodology that combines technical, fundamental, and macro factors. He's also passionate about educating investors to manage their money better. Welcome to the show, sir.
Thank you, Akshara. Thank you for having me. It's always good to speak to you.
Yes, sir. Same here. So, before we could start, let us not, start off with a negative note, but still, I had to because October had witnessed a heavy sell-off from FPIs, and it will almost record over 1 lakh crores of selling from the exchanges. So, what is your perspective on it?
I think it's a short-term blip overall in the overall India growth story. Now, over the past few quarters and years, we have been hearing a lot about the India growth story, right? And I definitely believe in that India long-term growth story. And obviously, over the next 10 years or so, there'll be very good money made in Indian equity markets, but at the same time, it will not be easy. Why I'm saying it will not be easy is because everyone recognizes this India growth story. India has been, over the past few quarters, been a bit expensive market. If you compare it to China and maybe other emerging markets, India is one of the most expensive markets. And that's why whenever we have things like what's happening in China with China stimulus or US elections or even the recent results of Nifty 50 companies, which hasn't been great, you're going to see sharper corrections. And that's why I say it will not be easy to make money, but definitely there is a very good money to be made over next 10 years.
Okay, so that answered my upcoming questions as well. But diving more deeper into
Yeah,
the valuation part.
yeah.
How do you see the current? Of course, when you see Nifty 50, have the expected valuations never turned up, and if you can see the quarter two earnings also were not as expected. But how do you see the next quarter two, quarter three, and quarter four earnings coming up, and how does that is going to reflect the domestic market here?
Yeah. So see, our expertise is not in predicting the markets, whether it's predicting the markets or predicting anything, any event. Now you ask me about the next few quarter results. So our expertise is definitely not into prediction of these results, but whatever those results are. So what we are into is quant investing, and what quant investing does very well is, as you spoke in the earlier few minutes, that it recognizes those trends very well and is able to adjust, right? And that's why I would never like to comment on what's going to happen. It's a very, very hard thing to do, predicting markets or predicting any sort of events, be it US elections or any sort of events. It's very hard to do, and it's really there's not too much of value in it. So that's why we don't like to predict these kind of events. Whereas what we like to do, our investing style is more like be prepared or be prepared to adapt to what is happening. And that's how our investing philosophy is. And that's how I think most of the good investors, whether it's quant or discretionary, I think most of the good investors, they don't really rely on predicting so much as they rely on adapting to these changes. So that's what I have to say about next few quarters. Really, I have a very low idea about that.
Got it, sir. So when you say quant, it is always related to numbers. And
Yeah.
markets are a combination of macros as well as microeconomic conditions. So, in what factors do you think it's going to influence your quant strategy? Like, what amount of percentage have you given to this macroeconomic conditions? Like, it can be U.S. election results, or it can be any slowdown in any other nation.
Yeah.
How does that impact So what is the indicator that's going to impact in your strategy?
So see, there's no direct indicator. If you talk about these kind of events, there'll definitely no direct indicator as such. But quant is a mixture of many uh, micro strategies. Now, these could be based on technicals, these could be based on fundamentals, or as you spoke about, these could be about macro factors, right? So one of the things that is now coming up is sentiment analysis, right? So any specific sort of event that is happening, and what is the investor's outlook on it? What is the investor's take on it? And investors are always discussing their views on, let's say, YouTube, on Twitter, or on these uh, news reports, right? So a good quant strategy should be able to analyze. That's what we are currently working on, that we should be able to analyze these trends that are going on, these using the sentiment analysis, and accommodate that in our strategies. So that is one of the things that a good quant strategy would be able to do in the near future.
Okay, so let us cut back to the basics of quant
Yeah,
now. So if you could explain the fundamentals of quant investing and its
yeah,
importance in today's financial landscape. Like, so for example, if I'm a traditional discretionary investor, could you help me to understand the benefits of systematic investing
yeah.
over the approaches in very simple terms?
Yeah. So I think you just use the word systematic investing. I think that is what reflects quant investing in a much better and simplistic words. Because quant investing is really not very complex. So what we are trying to do is essentially what any traditional discretionary fund manager is trying to do. So let's say a fund manager whose style is value investing. So what he or she does is um, they like to pick out the undervalued stocks, be it of any sector, let's say. They would like to pick out on undervalued stocks, and based on multiple parameters they might be using, right? Based on the growth prospects, based on the current valuations or other factors, right? So the factor could be any number or any type of factor, but what they are essentially trying to do is pick undervalued stocks. Now that in quant investing is known as value factor. So even in quant, what we try to do is pick undervalued stocks using value as a factor, right? Another set of investing style could be quality, wherein they don't focus too much on how undervalued a security is, but rather what's the kind of quality, whether it's a good quality stocks. Now, again, that quality can be defined in multiple ways,
Yeah.
but that is essentially using quality as a factor. Now, that also a quant manager can use, or it could be growth, right? So, one of the fund manager uses growth companies which are growing at a very fast pace. Again, you can define it in multiple ways, whether it's growth of revenue, growth of sales, growth of EPS, or growth of profits, and how consistently they are growing. So this as a factor in quant for world, we call it as a growth factor. Now, there are multiple factors. Now, whatever factors currently I've discussed, they are more or less fundamental factors, which traditional fund managers have also been using. So in that sense, it is very much correlated with the traditional way. Only thing is, it is very systematic in nature, right? So I have identified rules as to how I am going to pick undervalued stocks or quality companies or growth or momentum. So there are over 100 factors that we have identified, and we use those factors to pick stocks. Now, only difference is a, a traditional fund manager might have his own favorite. So he might be very good at, say, picking quality stocks, right? So he would most likely be leaning towards quality as a factor, right? Whereas a quant manager, what he or she can do in a better way is they can look at multiple factors, right? And figure out a way to put those factors together and then pick stocks. So that essentially is a more robust way. If you are using multiple factors to pick stocks, that is more robust, more likely to work in the long run. That approach, as compared to, let's say, being focused on one specific factor, which might work in one kind of market, but might not work in another kind of market. So it's
True.
essentially we are trying to do pretty much the same thing as traditional fund manager, but use computers in a very systematic way and make it much more diversified so that the strategy is more robust. The stock picking or the portfolio construction approach is more robust over long run.
So basically, ST is into all four quadrants. Like it can go into quality, growth, value, and also momentum. So it is in the
So,
all four quadrants.
no, we are into actually, if you say we take a 360-degree view. And to do that, we have identified over 100 factors. Now, here I've just mentioned four factors, but
Mm.
we have identified over 100 factors that we use to pick stocks. Now, these are the four factors that we currently discussed. These are very popular factors. But then there are other factors. One is very popular is again momentum, right?
Mm.
But then there are other factors like insider buying and selling. So the company's management, which company's management is buying its own stocks. Now, that's a very important piece of information for me, right? Or FIIs, what stocks they are selling or what sectors they are selling versus they are buying. Now,
Yeah.
I use all of these kind of factors as well in my stock picking approach, right? So it's a 360-degree view. And here we just spoke about few specific stock specific factors, but it could be sector specific factors also, like prices of essential commodities, let's say crude oil. Now,
Mm.
crude oil might affect airline in a very different way than it might impact, say, an automobile industry or banking industry, right? So prices of essential commodities or inflation or interest rates. Now, these are more macro factors that impact a certain set of sectors in a very different way as compared to others. Now, we use these sector specific factors also. And on top of that, what we also see is global macro factors. How fast or slow different economies are growing,
Yeah.
right? So overall, the world, how fast or slow it is growing, or what are the kind of headwinds it's facing. Again, purely on the basis of numbers, quantitatively speaking, right? So I use
Yeah.
all of this to take 360-degree view of the stock market and then pick stocks.
Good. So when you pick stocks, it's just not about the quantitative factor, but also the qualitative factor here. So when you say the data is available everywhere, just few lines before when you mentioned, so
Yeah,
data is available everywhere, but authenticity of the data is a question mark. So when you
exactly.
want to capture the qualitative part, which is readily available, but still, how do you find that is a perfect qualitative factor that you can analyze in your strategy?
Yeah. So that is something that we have learned over the years, right? So let's say it's been slightly a tough journey, but it's been very rewarding one. So let's say you want to take a call on the quality of management,
Mm.
right? One of the very good ways of identifying quality of management is you go and speak to them,
Yes.
right? But then there is a downside to it also. And I've known very many traditional fund managers who actually avoid talking to the management. Because if you talk to the management, they're going to, and this is not my opinion, but their opinion, why they don't talk to the management. And they are very traditional fund managers, the way they pick stocks, right? So their view is if they talk to the management, the management is always going to show you a very rosy picture, and you will get biased by their views. So whenever they are researching a stock, they never actually talk to a manager, talk to
Mm.
the uh, management, right? And that is a strict thing that they do, that they are never going to talk to the management because they always get biased by it. So it's not always a positive thing that you are able to talk to management. Now, secondly, but you got to take a view of how the management is, and that's a very qualitative one, but it can be actually identified in numbers also. See, at the end of the day, a company's results, now that data is not very high frequency. That data you don't get on a daily or even monthly basis. That data you are able to identify on a quarterly basis. How are the results of a
Yeah.
specific company, right? So results of a company speak a lot about the quality of management, or let's say the kind of auditing firm they are using. That
Mm.
says a lot about the quality of management. If it is a good quality auditing firm, a well-renowned one that they are using, that says a lot about the quality of management versus a company which is using somebody which is very new firm or not very well known, or a firm which is known to innovate in accounting, right? So then you really can't rely on that management. So these are indirectly, these kind of things are indirectly telling us about the quality of management, right? Or it could be, let's say, brand loyalty. It's a very
Okay.
subjective thing, right? But it actually can be measured in numbers also. How it can be measured, let's say, by retention rate of customers or by repeat customers, right? So if
Mm.
you see these metrics, that tells you a lot about the quality of or the brand loyalty,
Yeah.
right? Which is a very subjective thing. So in quantitative field, what we are exactly trying to do is there are many qualitative factors that you just spoke about. We are just trying to figure out ways of how those qualitative factors can actually be represented in numbers. Now, in many of these things, we have been successful, and there are many things which we are still trying to get better at. But at the end of the day, that is what we are trying to do, and that is very much possible also with the kind of data set now these days which is available, that most of these qualitative factors actually can be quantified in numbers and then be used in a quantitative strategy.
Got it. When you explained it so much, one part I just understood is in the qualitative part, that is where, the fund manager's role is there. When the quantitative is all about numbers. The
Yeah.
qualitative part, of course, you mentioned it can be converted into numbers, but that is where, the minimal role of the fund manager in a very specific quant strategy is involved. So how far is your involvement into the strategy?
So our role primarily is in two areas, and that's where we think we add the most value. One is defining of these factors. So when I say value as a factor, where we are trying to identify uh, undervalued firms, how do you identify it? One of the very basic things that you can do is use PE ratios, price to earnings, or add a level of one more growth on top of it.
Big ratio.
So the peg ratio, right? So how deep can you go into this, into how you identify these undervalued stocks? So that is one value addition we as a fund manager do in trying to pick quality stocks or growth stocks, how well you are able to define those parameters,
Okay.
right? And the second value add where we are doing is, which is the factor that is likely to work in the current market regime, whether it is in the next 3 months, whether it is going to be undervalued firms or good quality companies that are likely to work, or let's say the stocks which are in momentum that are likely to work, right? So, so what we are trying to do is trying to pick which factors are likely to work, because I have 100 factors. If I pick everything, if I use all 100 factors to construct a portfolio, it will essentially be very close to index, right?
Mm.
The way I can add value is in figuring out which factors are likely to work. So what happened, say 3 months back, actually, prior to that, most of our weightage was in momentum stocks.
Mm.
That was the theme that was working beautifully in last 2 years or so, after 22 actually. But 3 months back, our algorithms told us that the quality as a factor, good quality companies would have a better near-term run. And that's where we decided to shift our weightages from momentum to quality. So momentum still does have some weightage, but the maximum weightage now is being
What to
taken
the
up by quality stocks.
quality?
And that has actually helped us overall avoid the kind of losses that the momentum funds have seen, right? So
Okay.
these are the two broad areas where we as fund managers try to add value to our portfolios.
Okay. Actually, quant is always a buzzword now. And in today's current market situation, quant is always a buzzword. What generally when you say quant strategy, it is always just equalized with the model portfolio. Just say that they have formulas. When the formulas are set in,
Yeah,
they pick up stocks and they put into the investors portfolio. That's how that has been trend.
yeah.
So how does your con strategy is different? Like, a person just a moment before you just told me that, 3 months back you were into momentum and now you are into quality. So
Yeah.
the investor would have joined 3 months back, the stocks would have been different to the investor who have joined 3 months later.
Yeah.
So how does that, how do you see that?
So for us, we take the model portfolio approach only, because what model portfolio tells me is that this specific portfolio is the best suited for all the investors. Now, whether that investor came to me last month or whether he has been with me for last 5 years. But if he has given me some money, what is the best portfolio I can construct for him or her right now? Right. So irrespective of how long they have been with us, this model portfolio is the best portfolio I have currently for my investors. And
Okay.
that is the portfolio where I'm going to invest their money in, because I don't have any other portfolio, any other better portfolio, right? I don't have any other reason to be different to my two investors just because one investor came to me 1 month back versus another investor who came to me 5 years back. I really don't have any reason to give them different portfolios, frankly.
Okay, so in spite of the market change, the more how it depends upon the formula and the model portfolio.
Exactly. Yeah.
Got it. And when you say quant and its strategies, the second thing that comes into the mind is the indicators. So when you find it as very volatile,
Mhm.
generally the active fund managers who are non-quant, they prefer to sit at cash.
Yeah.
They immediately take a cash call and they sit at cash. But when you compare same with quant, doesn't happen unless and until the model the indicator says it. A fund manager cannot take that call here.
Yeah.
So what are the indicators that you see to take a cash call?
So your first part of the question, where you stated that a discretionary fund manager would take a cash call. I
Hmm.
don't think that's always true. There are these are different styles. Now, there are few fund managers who obviously take cash calls, but then there are other managers who always want to be invested in the
Hmm.
markets, right? Uh, our investing philosophy is that we always want to be invested 100% into the markets. Right.
Okay.
So we almost never take cash call. In the last 5 or 6 years of our PMS existence, there's only one instance that we have taken a cash call. That was during the COVID. Just
Okay.
for that 1 month, we took a cash call. Otherwise, we almost never take a cash call. Right. But definitely during the volatile times, if there's sideways or downward trending market, you have got to protect your investor's portfolio. How do you do that? One way is taking a cash call.
Yeah.
But taking a cash call is not very simplistic, because you've got to sell at the right moment, and you'll be able to add value only when you are able to enter also at the right point of time. If you are late at entering, you might lose everything and you might actually miss out, right? So even during the COVID times, there were many fund managers who took cash call, but who were very slow in entering back. And they actually lost a good part of upside also, right?
Yeah.
So it's not very straightforward to take a cash call. Another way of reducing risk is you shift from aggressive stocks to defensive stocks.
Got it.
The way we do it is using factors. So there are certain factors which are known to be more aggressive, like momentum and growth. And there are other factors like quality, low vol, or value, which are more likely to work in the falling markets, so these are more defensive factors. So what our algorithms do is during these times, we actually shift from aggressive factors to defensive factors that help us in protecting our portfolio. So our portfolio becomes much more robust or less risky actually during these times. So that's the way we believe in reducing risk in our portfolios.
Good. And when you talk about the whole portfolio as a whole, third thing that comes into anyone's mind is sector. The sector allocation. Of course,
Yeah.
most of the quant strategists are sector agnostic. They don't
Yeah.
we cannot ask, what sector do you prefer, because they remain sector agnostic.
Yeah.
But there are few sectors where where the sectors are overvalued, but some of the stocks within them is undervalued. Similarly, it happens vice versa, the other way also in overvaluation part. So that is where, it is important to identify this, stock first and then the sector. So what are the indications that you find in seeing some sector is overvalued, not a stock, the sector as a whole is overvalued or undervalued?
So, Akshara, what we are doing is this is something that we have actually came up about 2 years back. So, quant investing, most of the fund managers, what they are doing is they're ranking these stocks, right? What we identified is certain factors which we use to even rank sectors,
Hmm.
right? So that is a new thing that we have started doing almost 2 years back, and that has actually yielded great results in terms of enhancing the returns, but also reducing risk and reducing the churn, right?
Hmm.
So this sectoral block that we added about 2 years back had actually helped us uh, improve our portfolios in multiple ways that I just told you about. So it's not only about ranking these stocks, it's also ranking, we are now ranking these sectors, which has actually helped us a lot. So see, we have a fairly large research team. I think one thing that differentiates us from any other manager would be our focus on research. Irrespective of the results, I think our focus, there's a huge focus in our firm on the research process and how do we improve it, right? And this improvement has led to adding this sectoral block. Another research area is, I earlier spoke about sentiment analysis. Now that is something that we are really passionate about to add that, and that is something that we might be adding in the next few months or maybe quarters. But those are the things that we continuously keep working on. So this sectoral block that I just spoke about has actually helped us a lot overall in the last 2 years to generate the kind of results that we have been generating in our PMS.
Good. When you were explaining, you just used a word about churn, churn of sectors and stocks. Churn really plays a vital role in any portfolio. And when you compare it with any other portfolio, Quant has a bit of higher churn ratio when compared
Definitely.
to any other normal
Yeah.
portfolio. So when churn is always proportional to the tax paid by the investors. So how do you see that? How do you see this being answered?
Yeah. So there are two aspects to it. One is obviously you spoke about the taxation part. Now, what we have seen is if you churn less, now I can definitely churn on a quarterly or yearly basis. Currently, we churn on a monthly basis, right? If I actually start churning on yearly basis, then definitely all my realized gains would be in the long-term category. So my tax liability would definitely be lower.
Yeah.
But if I'm actually churning means rebalancing my portfolio, right? If I'm rebalancing my portfolio on a yearly basis, then I've actually missed out all the edge that a quant can give me.
Hmm.
The biggest edge of quant is it's able to analyze that huge tons of data uh, in no time, actually.
Hmm.
Very fast, we are able to analyze that data and make sense out of it. Right. So if I
Yeah.
don't use that to my advantage or just because of taxation, I'm actually leaving money on the table for investors. So obviously, if I rebalance on a yearly basis, my churn would go down, but my
Yeah.
alpha would also go down. Whereas if you compare it to monthly rebalancing, where my churn is higher, right? But my alpha is also high. So net at the end of the day, what investors want is highest tax adjusted returns, right? Post
Yeah.
tax adjusted returns. So what we have seen is these post tax returns are highest in case of monthly rebalancing. That is one thing. Now the second aspect to this is it comes in risk management, right? So if I'm churning or rebalancing my portfolio on say yearly basis again, now, uh, if a stock is not working for me, I will actually keep holding it for a year, right? Whereas if I'm doing this churn on a monthly basis, then I am very quick to actually remove it. So that churn is actually giving me advantage in terms of risk management. So if you see our stocks, so last year we produced about upwards of 50%, I think, in our in returns. Now, if you
Hmm.
see our returns, there'll be many stocks which has given me 80 to 100% also, right? So the top 10 stocks which has given me these returns would have easily given me 80 to 100%. Now compare it to the ones that have lost money for me, right? So if you pick the bottom 8 to 10 stocks, they would have lost maybe 10 to 15% only because of this churn, I'm very quick to remove them from my portfolio. So in that sense, it's actually helping me in better risk management. And that is why um, the risk adjusted returns that we optimize our portfolios for, our risk adjusted return is almost double that of BSC 500, which is our benchmark index. So that's what I have to say. There are two sides of it. One is the risk management also, and also the post tax returns, both of which we are able to optimize in that monthly rebalancing.
In short, it's basically you need to investor from an investor perspective, you should choose an alpha over the churn. So
Exactly. Yeah.
more of alpha is what you want to consider than looking into the churn of the
Yeah.
portfolio.
But also that alpha has to be post-tax.
Yeah.
So when you see post-tax, this higher churn actually will be beneficial rather than a low churn quant portfolio. Because as a manager, it's very easy for me to design a rebalancing strategy which does it on 6 month or yearly basis, right? But I'll miss out on all the advantages that a quant strategy can give me.
Yeah.
Yeah.
True. Okay, for example, if I am an investor and I'm looking out for an investment for next 5 to 10 years of horizon. So, like, what are the major investment trends that is emerging that you would look to give for investor? Because as your introduction said, that you love teaching to fellow investors. So,
Yeah.
if you were to give an advice on that.
So, Akshara, at the start, I also mentioned that we don't really like to uh, take these kind of calls, whether this is for next 6 months, which sector is likely to work, or for, let's say, next 5 to 10 years. Now, there are many stories going around that this specific sector or this
Yeah.
specific theme is likely to work in next 5 to 10 years, and most likely, let's say, they are true. Our approach is, and I personally, that is my personal investing style as well, that I don't like to predict, as I said, but you should be very fast in adapting what is happening. Now, let's say EV as a sector, right? Electric vehicles. Let's say it gives you a very good returns. But what is also important is you pick the right stocks in that specific sector, right? To which are the best stocks in that specific sector at this point of time. Now, there might be few stocks which are very, very richly valued. So next 3 to 5 year earnings are already priced in, and you will get average returns even from those EV stocks, even though that sector as a whole does well, right? So it's what I'm trying to say here is more than we are always spending most of our time as investors on predicting the next stuff. Whereas what we should learn is to adapt. If we are
Okay.
able to do well, I can tell you one very interesting story. Last time when Donald Trump was elected, I think 2016 was the year. At that time, most of the US investment banks, they came out with their research that Donald Trump is likely to win. His probability of winning is just 20%. Okay. And if he wins, if that 20% were to come true, then the markets would correct about 25 to 30%. Okay. What actually happened? That he won that election.
Yeah.
And after he won, within next 1.5 to 2 years, markets gave, I think, 30 to 40% returns. So
Yes.
nobody were able to predict who would win and also the consequence, right? Only those investors were able to do well who were able to adapt to that changing, even though they were wrong. There were many investors who would be wrong. But if you are able to adapt well and listen to what market is saying, only then you will be able to do well. So I really don't have any specific answer to your question, which specific themes or sectors that are going to do well. But the way an investor should react is adapt to the changing market conditions, right? That is what I have to say. If you are able to devise your investing style in a way where you are always adapting, not predicting, but adapting, you would always do well, no matter the theme, right? So that's what I have to say. Just try to adapt, just try to devise your investing style in a way that you keep adapting to what is happening. If you're able to adapt, you will do well, no matter whether your predictions are right or wrong. but you will always do well if you are able to adapt.
It's basically like, rather timing the market, time in the market is more worth. Okay,
Exactly.
got
Yeah.
it. Thank you. And let's move on to the last question of the day, which is like, could you, of course, we spoke a lot about macro factors, markets, and about quant as a whole. Now it's time to jump on the strategy. So let me have one basic question. Can you provide an overview of your long alpha and I alpha as a strategy and their performance?
Okay. So let me quickly talk about our I alpha strategy because we haven't spoken about that. So that has been running for 15 plus years. It has the phenomenal track record of never having a negative month over the last 15 years. It's an arbitrage strategy. So it does not take in call in the markets whether the markets are going to go up or down. Irrespective of what is happening in the markets, what it will do is it will take an arbitrage trade between Nifty and its 50 components. So if Nifty is undervalued, it will buy Nifty and sell the 50 futures.
Yes.
Whereas if Nifty is overvalued, it will sell Nifty and buy all the 50 futures.
Futures.
That's what this strategy is, which is fairly simple. The why we have been so successful in this is because of our infrastructure. We have very low latency, high frequency infrastructure, which is some of the best infrastructure any firm can provide in India. Right? Using that, we are able to trade this strategy, and that's why we have been able to produce the kind of returns, roughly 12 to 13% annualized. We have been able to produce in this strategy, irrespective of the markets, right?
Mm.
That's the I alpha strategy, which is targeted towards a very conservative investor, an
Mm.
investor who typically invests in, say, FDs, uh, who usually invest in these kind of products, but it is far better than FD.
Okay.
In terms of returns and also in terms of risk, as I've told you, not in a single losing month in last 15 years. Now,
Yes.
long alpha is a strategy which we launched about 6 years back, right? That's a multi-factor strategy. As I've just explained, we use over 100 factors to select stocks and also pick out of those 100 factors which are the ones that are likely to work. So what we are doing again in this is we never predict this is likely to work, whether it's momentum or value or growth. We always try to adapt. So the downside to this strategy would be um, you would be slow at times. So let's say we were talking about 5 or 10 year themes, and let's say that theme starts in EV. Now, for me, there is no reason to pick EV at this moment because even let's say EV is currently not identified by the market, right? So it will be an undervalued theme. So
Mm.
a fund manager who is picking EV because it is undervalued will be the first to enter, right?
Mm.
But the risk is he or she will be holding it until unless the other participants have identified. Only then it will start picking up. So there
Yes.
is a definite, uh, uh, and this could undervaluation could be in years also. That
Mm.
for years that market hasn't identified that theme. Now we as quant managers would only enter that theme when the market has actually shown that yes, the returns are there in that specific stock or in that specific sector. And secondly, over the next few quarters, results also start supporting that trend,
Okay.
right? Only then. So we'll be slow a bit in entering, but we'll be holding it and we'll have a very dispassionate or unemotional view of that sector. Because as soon as it starts correcting, I'll be first to get out also, right? Whereas a discretionary fund manager will hold it. So there are
Mm.
pros and cons for each approach, but I'm just trying to say that the cons is that we might be late in entering a bit, but we'll also be the first one to book profits and get out of those corrections because there would be very good corrections in those larger themes, right? So those are in a sense the advantages of quant as compared to discretionary. It's different style, right?
Mm.
It's different, and that's why I believe that investors should give quant some part of the allocation because they'll be actually able to diversify their portfolio in a much better way if they do that.
Got it. So, may I just a small doubt that arose when you were talking. When you are late to identify a sector or a theme, or it can be a stock, and when you enter a bit late. So don't you think that profits earned before are missed? The
Yes.
timely factor
So,
is being missed
so
here?
see, there are always two sides of the story. The profits are missed in the initial part.
Yeah,
But if you consider a 5-year theme, let's say, and if I miss initial 2 quarters, right, it's hardly anything I've missed. But on the upside, what I have done is I have not missed the time. So I also explained to you, if a theme is undervalued, it might be undervalued for a few years also.
got it.
Right. And during that time, if I have actually invested in that theme, that investment would be a drag on the overall portfolio returns. So that is the upside uh, in this strategy, right?
Thank you, sir. That was a well explained one, and you have answered all my questions. And also, I hope this listeners will also be enlightened throughout this interview. Thank you for taking your time out, sir.
Thank you, Akshara. Always good to speak to you. Thanks a lot for having me. Thank you.
Thank you, sir.